I'm Jordan Hucht from Vision Wealth Partners, and today we're going to discuss a polarizing topic in the investing world: active versus passive portfolio management. Now, both sides argue convincingly that their approach will generate better returns over time, but it can be confusing, even paralyzing, for average investors to make sense of the rhetoric and develop a clear, disciplined strategy tailored to their individual needs. Let's examine each approach, including its relative strengths and weaknesses, so that you will gain a better perspective on the debate and ultimately more clarity about your own investment approach. Let's start with active management. Active management is simply an attempt to beat the market as measured by a particular benchmark or index. The S&P 500 and the Russell 1000 are two benchmarks that measure performance of large cap US companies. Active managers that buy these types of companies attempt to give you a better risk-adjusted return than the benchmarks. Active managers look at the economy, political events, and company-specific factors to determine which stocks to buy and when to buy them. Of course, it is just as important for these managers to determine when a stock should be sold. The concept seems simple, right? But the catch is that these active managers incur significant expenses in conducting their research and effecting frequent transactions, and these costs are passed on to investors by reducing their net return. For example, before any fees are assessed, a manager might beat the relevant index by 10%. Maybe the manager earns an 11% return when the index gained 10%. But after management and administrative expenses are deducted, the margin over the index could be greatly reduced or even eliminated altogether. In addition, the very nature of active management leads to frequent buying and selling of securities, which can lead to significant realized gains and create a tax drag on investment returns. Certainly, any return in excess of the index is preferable to the index return, but the point is that beating the market is difficult, especially when factoring in the costs of active management. Passive management, on the other hand, makes no attempt to beat the market. Passive managers simply buy the same stocks in the same proportions as the relevant index or benchmark. Therefore, returns closely track the return of the particular benchmark. These managers also incur expenses, but the costs associated with passive or index investments are typically well below those of actively managed investments. Over time, it's the lower cost of investing that many believe will allow passive portfolios to provide higher returns than active portfolios. So which is better? It's impossible to say with any certainty whether active management is more beneficial than passive, and we don't believe it's a one-size-fits-all answer. Like most things in financial planning and investment management, the answer is, it depends. It depends on the particular investor, it depends on the tax type of the account, it depends on the asset class, and a number of other factors. And in many cases, it makes sense to use a combination of active and passive management to take advantage of their relative strengths. For example, using passive management in taxable accounts and active management in tax-deferred accounts is a common strategy to mitigate the tax cost of active management. Another example could be to use passive management for very efficient asset classes like US large-cap stocks, and active management in less efficient asset classes like emerging market equities or international fixed income. Again, there's no right or wrong, and there's no uniform answer. Different management strategies serve different purposes, so what matters most is using strategies that align with your investment and financial planning goals. For more videos on a variety of wealth management topics, head to our YouTube channel or subscribe. Thanks for watching. I'm Jordan Hucht from Vision Wealth, your dedicated wealth management partners.